Nevertheless, for any FY falling within this period, qualifying companies can choose to apply this on the qualifying transactions if they meet the qualifying conditions. So there are a lot of words being mentioned for qualifying because the IRAS has given specific conditions that, the main is that the company needs to perform these specified activities uh, to qualify whether their activities, marketing and or distribution qualify with this SSA approach. If they don't qualify, then obviously the company needs to prepare a full-fledged documentation, the analysis, the benchmarking. If they strictly meet the guidelines, then also a transfer price and documentation is required. So that is something which doesn't go away. The only thing which changes is the approach towards the benchmarking, because then the OECD has given a certain range for applying the markup or the margin. And if the company's margin or the markup is falling within that range, then it can apply this kind of approach. But the documentation per se still needs to be applied. So this is kind of a little bit of relaxation to the companies whose transactions qualify under the SSA, and how they can apply this SSA to determine the arm's length price for their baseline marketing and distribution. But uh, the detailed conditions will be still be formulated, but they are primarily taking into consideration from the OECD guidelines. But for everyone's reference, primarily most of the qualifying conditions for the activities will be very low value adding activities from a baseline marketing or distribution. So in the sense that the company is only and only a low value adding service provider or a distributor without undertaking any risks or any critical functions or any kind of assets. So although in today's landscape, it's difficult to identify such companies, but in case since the IRS has introduced this section from this year onwards, it needs to be analyzed. If any of the company is meeting those conditions, then in their transfer pricing documentation, which needs to be prepared, they can apply this approach, and that obviously reduces the administrative burden on the company. And that is the main key reason why this has been introduced. So it all depends on the correct assessment, which some expert like us can do, and then accordingly identify and advise it whether the SSA will apply or not apply. So these are the main 7 key amendments which have been made to the TP guidelines. Uh, if you see, they are different in nature, whether it's the SSA or the intercompany loans or disregard of the RPTs or the dating of the transfer pricing documentation. But the IRS has tried to cover most of the kind of transactions and business models in these key amendments, and most of them are obviously in line with the OECD guidelines, because we take our reference from most of the guidelines from the OECD, and that's why some of the amendments are quite correlating to the OECD action plans as well as the OECD BEPS 2.0 program. Now, so these are the main key amendments. Now, what is the practical implications for companies like you? Because ultimately, at the end of the day, we would obviously like to highlight that what are the practical takeaways for companies, because that is the main thing which every company wants to understand, that okay, these are the amendments, so what do I do, right? So going one by one, uh, for the simplified documentation, obviously it's very straightforward, but ultimately it lays the importance of preparing a simplified documentation, right? Subject to meeting the thresholds, obviously, and preparing it on before time and dating it properly and having the proper analysis in place. Uh, so that is obviously lays more of emphasis on importance on the simplified documentation. So the main key takeaway for your case is, depending if you are qualifying for a simplified documentation, that please do prepare, right? And it has to be prepared because that is what the IRS has very clearly mentioned in the guidelines, that a simplified documentation is also going to be considered as a proper TP documentation under section 34F. So it's not now that they will say that simplified documentation is not a formal documentation. It is. So that's why whether it's full-fledged or simplified version, the TP documentation needs to be prepared. Coming to the second practical implication for a disregard of a related party transaction or TP adjustments. So as I mentioned earlier, that there has to be a proper commercial rationality for each intercompany transaction, depending upon in which jurisdiction your related parties are or what is the related parties' roles and responsibilities, which can be done by the way of an agreements as well as the documentation. So there should be not kind of any situation that there are any kind of transactions lacking commercial or financial substance, or having related parties in different tax haven jurisdictions, or any other kind of that uh, the Singapore entity is incurring losses for a number of years, and the related parties are always into profits. That is also one of the example of a different or a uh, disputable RPT, because the one of the company is incurring consistent heavy losses and the other related to parties are on a consistent basis earning profits. So that is also one of the example that there is some commercial or business rationale which is not being taken care of or being taken into consideration. So for each kind of transactional arrangement there has to be a commercial rationality. And uh, similarly, for transactions related to intercompany loans or other transactions like royalties, there will be obviously withholding tax requirements when the company or Singapore entity is making any interest payments or royalty payments. So those withholding tax requirements are also mentioned in the guidelines. They need to be taken into consideration. And at the same time, uh, the capital transaction which I was talking about, they need to be very clearly identified and put forth in the tax return, so that when we are taking a position on the documentation, we clearly mention that this transaction is purely capital in nature and it is consistent with the tax return. So the IRAS has also given this point that it has to be consistent, and the takeaway from our end would be that if the position is consistent between the tax return and the transfer pricing documentation, then the chances of this kind of capital transaction getting disputed are very low, because there is a proper consistent approach which the company has taken. Now, the third takeaway for the revision of the surcharge is purely from a point of view that if all the transactions are transacted on an arm's length basis, along with the documentation, that that solves a lot of problems for the taxpayer, and then there will not be generally the case of any TP adjustment. Obviously the IRS will ask questions, but if the company has a proper analysis in place and proper benchmarking, then the question of a TP adjustment will generally not arise, right? Unless and until the analysis has been completely done uh, in a in a very wrong way, which is absolutely beyond the principles of TP. Then of course they can have a question. They have a right to ask questions and make any adjustments. But practically speaking, it will only happen when the company has not done anything in the past, and the IRS is asking them questions now. Uh, for the strict pass-through cost, uh, the companies must examine and analyze each and every transactional arrangement in detail and ensure that the backup documents would mean either a written agreement or a email correspondence, which clearly reflects the actual fabric and the nature, and consistency with the audit report, which clearly shows that these are strict pass-through costs and they are not services in nature. Because that connect between the audit report and the transfer pricing report has to be in place. From an intergroup financing arrangement, the main key takeaway would be that the financing arrangement should be structured in that way they are not hybrid instrument, as long as possible and as far as possible, depending upon the business reality. If it is possible not to have a hybrid arrangement, it's obviously very good from a taxpayer point of view and from a tax authority's point of view. But if at all the business needs a hybrid instrument, then at least the elements of the hybrid instrument needs to be very clearly bifurcated, that this is related to debt, this is related to equity, and this is related to any other financial uh, instrument like a preference share capital, or this is related to a bond or a corporate guarantee or financial instrument. So the elements of the arrangement of the financing needs to be very clearly bifurcated, that this is what will be happening in this instrument. So as long it's not an hybrid, it becomes easier. But if it is, then the structure should be that it should not overlap on each other, because the moment it becomes an overlapping instrument, then the question for changing or asking questions and disregarding such an arrangement becomes quite high. Uh, Intercompany loans, which we have also talked about in our previous webinars, it's extremely important, whether it's domestic or cross-border, they must be analyzed. the moment if you have any loan transaction, whether it's borrowing or lending, please do apply interest rate. Interest rate mechanism is completely now out of the question. Depending upon the quantum, please have in place an intercompany loan agreement and intercompany interest rate benchmarking, whether it's an indicative margin or proper. And please have in place a proper documentation to ensure that the loan transaction per se is not being disregarded, because that is something which is very critical at this stage. And because we have many instances that wherein the loans were in the past always without any interest or interest free, but now with these amendments, this is something which we would like to lay quite a strong emphasis upon, apart from the other uh, takeaways. And the last one for for the SSA, still as I mentioned, these rules are still evolving, but of course it's a welcome sign. As I mentioned earlier, it's a welcome sign for tax companies with qualifying transactions. But uh, the feedback what we had got initially, or the initial response what we got from companies, that hey, that now we have an SSA, why do we have to bother? The the unfortunate part is that there is still compliance work to be done. A transfer pricing documentation needs to be prepared. It's not something uh, which is not to be done. That goes without saying. It's mentioned in the guidelines. It has to be prepared. Only the analysis for the qualifying transactions will change. How it is to be done, and exactly in accordance with the methodology and the approach which is to be followed as per the IRAS and the OECD, has to be seen on the SSA. But the first and the foremost requirement is that the qualifying transaction and the companies qualify for those transactions. If and it's actually all the conditions. It's not or. If there are 3 to 4 activities, the company should strictly and only provide those transactions to qualify. If it doesn't qualify even for one of the activities, then the application of SSA cannot be done. Then a proper and the normal way, like which we are doing, has to be followed. So as long as there is a absolutely strict compliance and with the qualifying conditions, that makes the job easier. Uh, but the main thing is to ensure that it actually qualifies. And the second is the documentation and the analysis has to be conducted as per the approach which has been given in the guidelines. So that is something, a practical key takeaway for companies from this year onwards, is that because this is from 2026, that one should definitely go into a proactive mode and analyze whether in the past what kind of activities were they having, marketing or distribution, whether they qualify under the SSA, and if yes, then accordingly it has to be analyzed as to how the documentation and the analysis needs to be conducted. But obviously this is from this year onwards, so this is more from a planning perspective. But apart from this, all the other uh, key takeaways and the amendments are more from a compliance perspective from financial year 2025 onwards, which is the relevant year as of now for which the transfer pricing documentation has to be prepared. Uh, so as a conclusion, because we still have another 10 minutes for the Q&A. So as a conclusion, the timing of the release of the guidelines obviously is very conducive. And this is on a commendable part from the IRAS that they always issue amended guidelines in accordance with the rapidly changing TP landscape, and they are fully aligned with the changes being made in the transfer pricing landscape, especially the BEPS 2.0. And this is for the first time in which they have introduced amendments like the SSA, or uh, changes like the hybrid instrument disregard, taking more of cue from the OECD guidelines. And SSA, obviously, as I mentioned, is purely taken from the OECD BEPS 2.0. And so this is the first time they have now brought into more elements into the TP guidelines from the global guidelines. Because if the TP landscape is going in that way, there has to be a proper shift in the guidelines from a local point of view. So obviously there are emphasis on TP documentation, whether it's a full-fledged or simplified, which now goes without saying a simplified version has to be dated, along with other clarifying the other issues like pertaining to domestic loans, capital transactions, pass-through costs, etc. So the timing is obviously quite conducive. The only thing is from financial year 2025, apart from the SSA, all the elements which we just discussed, they have to be taken into consideration and the action has to be taken ASAP. For 2026,